Hi everyone. Today we are looking at understanding the most common investment biases, what they are, why we have these, and how to overcome them. We will learn how your feelings can cloud your judgment, leading to decisions you might later regret. Hi, I'm Jayna Shah, a UK-based chartered financial planner with more than 17 years of experience. If you're new to the channel, please hit that subscribe button and the bell icon to stay up to date. Now let's dive into the fascinating universe of investment biases. What is a bias, you may ask? A bias is an irrational or illogical assumptions or belief that affects your ability to make a decision rationally based on facts and evidence. Emotions can be your best friend or your worst enemy when investing is concerned. Ever wondered why investing sometimes feels like an emotional roller coaster? It comes down to the evolution of the human brain, according to behavior finance expert Dr. Daniel Crosby. As he points out, our brains are wired to effectively deal with the threats that we faced hundreds of thousands of years ago. When humans lived in caves and jungles, these biases helped us survive. But we now live in a different era in which the same biases can sometimes lead us to make poor decisions. Many people overestimate their skills, whether it's changing a tire or managing their own finances. In investing, overconfidence often leads to people overestimating their understanding of the stock market or specific investments. This often results in poor investment decisions like trying to time the market, as in waiting for the market to bottom out before they invest. Sometimes it leads to investors investing heavily in risky investments or in excessive trading. On the other hand, professional fund managers have one significant advantage. They're trained to understand the impact of biases and can attempt to mitigate the risks. That's why it's generally better to spread your investments across a wide range of expertly managed funds. This is a tendency to feel the pain of losses more than the joy of gains. Literature suggests that people are 2.5 times more upset by a loss than they are happy about a similarly sized gain. So, say if you're a gambler, winning £100 is no big deal. But if you lose £100, you're pretty upset. We see this in stock markets too. Advisors get many more angry calls when portfolios are down 20% than they do thank you letters when portfolios are up 20%. We're all hardwired for safety. It enabled our distant ancestors to survive in times when resources were scarce. Today, this conservatism could lead you to avoid less familiar investment options and taking less investment risk than you should. Over a lifetime, this could cost you thousands of pounds. Loss aversion can make you cling to underperforming investments with the unwarranted hope that they will eventually recover. This may not be based on any logical reason, but just your attempt to avoid making a loss. If you continue to hold, make sure you're doing it for the right reason. Also, keep an open mind about alternative investment strategies and regularly review your portfolio with your financial advisor. The attention bias makes us overreact to current events. Remember, as a psychologist and economist Daniel Kahneman said, nothing in life is as important as you think it is while you are thinking about it. As investors, it can be all too tempting to try to react to events as they happen. That's because our brains are hardwired to confuse how striking an event is with how likely it is to happen. For example, shark attacks capture the public imagination thanks to movies like Jaws, but they're extremely uncommon. On the other hand, more real but sneaky risks like heart disease or diabetes are harder to imagine, and so we downweigh them. As investors, the answer is to try and avoid knee jerk reactions to short term events. The best investors do not seek to time the market by forecasting or reacting to short term events. Rather, they know that uncertainty is what they are being paid for, and so they adopt principles for the long term investing. Such an approach may lack the excitement of responding to every news headlines and market turn, but it will enable you to keep your eyes focused on the horizon. Particularly, meeting with a financial advisor can help you stick to these goals. This prompts us to selectively seek out information that reinforces our existing beliefs while conveniently disregarding data that challenges our convictions. For example, if you believe holding large US tech company shares is a great strategy right now, you will naturally gravitate towards media articles that confirm this. You will ignore any contrary opinions that may say perhaps these companies' shares are currently overvalued and not necessarily the best strategy to invest into right now. In the world of investing, confirmation bias may manifest as cherry picking data to validate investment choices and disregarding alternative perspectives. Investors often succumb to this bias following the crowd rather than making independent, well reasoned decisions. Fear of missing out or FOMO often drives investors to invest in trendy assets, potentially contributing to market bubbles and abrupt crashes. A good example of this is the recent trend where new rookie investors have been attracted to investing in cryptocurrency, even when they don't have much knowledge or understanding about these assets. This is where we give more weight to recent events and assume they will continue in the future. It can lead to buying when stocks are high and selling when they are low. That is exactly what you don't want to be doing. You really should be buying stocks when they are low and selling at a higher price. As a billionaire investor Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. When prices have continued to fall and there is pessimism in the market, that could be an ideal time to pick up some bargains in the stock market. These could be shares of companies that are making great products and services, but their prices are down in the short term due to an overarching market sentiment. Similarly, if prices continue to rise for a long period and others in the market are optimistic for an even higher level of growth in market prices, that could be a time to be cautious and sell your stocks before the market is overheated and crashes. Having now uncovered these common investment biases, let's explore strategies to effectively combat them. The first step in overcoming these biases is cultivating self awareness. Recognizing when you are vulnerable to these biases empowers you to take a step back and reevaluate your investment decisions. Diversification. Diversification emerges as a powerful tool to counter many of these biases. By spreading your investments across a range of different assets, you minimize the impact of any one single investment decision. Stick to a strategy. Consistently adhering to a well constructed investment strategy and resisting any emotional impulses is another invaluable strategy. This disciplined approach helps you avoid hasty actions driven by emotions like ego or fear. Education is key in the world of investing. The more you familiarize yourself with investment principles, the better equipped you will be at making rational decisions and overcoming these biases. And there you have it, a close look at the most common investment biases that can lead to expensive mistakes. Remember, understanding your emotions is a key to making smarter financial decisions and growing your wealth. If you found this video insightful, please hit the like button and share it with your fellow investors who need to know why their brains play tricks on them when making financial decisions. Thank you for watching, and I'll see you in the next video.